So if you buy a house today, you obviously want your name on the deed.
Right.
Yeah.
There's just standard procedure.
Yeah, it's like the ultimate proof that you own the property. It's an asset you can point to and, claim as yours.
Exactly.
But if you step into the world of the 0.1%, putting your name on a piece of property is actually, well, it's not a point of pride at all.
No, not even close.
In fact, according to the sources we're diving into today, traditional property ownership is considered an amateur financial vulnerability.
I love that phrase from the audit. It really it frames the entire discussion perfectly.
An amateur financial vulnerability.
Right.
Yeah.
It tells us that the standard operating procedure for, the rest of the world, having that direct, legally visible line between a human being and a physical asset that is actively avoided by the ultra-wealthy.
And, understanding how they avoid it is our mission for today's deep dive. We are looking at a really comprehensive investigative industry audit. It's titled The Billionaire Firewall, Architecture of Global Real Estate Secrecy.
It's a fascinating document.
It really is. So we're going to completely deconstruct this highly secretive shadow market of global billionaires and uncover the actual architecture they use to make these, multi-million-dollar mega mansions just completely disappear on paper.
Because when the asset in question is, say, a sprawling penthouse in Dubai or a massive high-tech mountain compound,
the rules of the game shift dramatically.
You do. The mechanisms of ownership transform from a simple public record into this deliberate, complex labyrinth.
Right.
The entire goal is to legally repel scrutiny.
Right.
While still retaining the actual benefit of the asset.
But, realizing that having your name on a public deed is a liability, that's really only step one.
Yeah, step two is the hard part.
Exactly. Step two is actually erasing it. Like, how do you make an 8-figure asset legally disappear? Because we're talking about a physical object here, right?
Something you can walk up to and touch.
Right. So let's unpack this. It's almost like buying a priceless painting, but instead of hanging it in your living room where everyone can see it, you lock it in a vault.
A very deep vault, yeah.
And then you basically hand the keys to a ghost.
That analogy is surprisingly accurate. You don't hide the house itself, obviously, because you can't.
Right. It's a house.
You just make the paperwork trail so incredibly long and convoluted that investigators just give up trying to find the center of the maze.
Okay, so what does this maze actually look like in practice?
Well, the foundational mechanism for this is a highly optimized wealth management technique. It's known in the industry as corporate wrapping.
Corporate wrapping.
Yeah. Under this strategy, the billionaire, the actual human being supplying the capital, they don't purchase the real estate.
Not directly, anyway.
Not directly, and not in any capacity that ties back to their personal identity. Instead, their legal team establishes a foreign shell company, or sometimes a trust.
So the offshore company is basically the entity showing up to the closing table.
Precisely. The shell company executes the purchase. So if a journalist, or say a tax investigator, pulls the public deed for that sprawling mountain compound,
they won't see some famous tech titan's name.
No, they'll see the name of an anonymous offshore entity.
Meaning, on paper, the human billionaire doesn't own a single square foot of brick or mortar.
Nothing at all.
They just own shares in a company, and that company just happens to hold the deed.
Right. They own absolutely zero real estate in that context. The property has been wrapped in this corporate layer, completely severing that public visible connection.
Wow.
But, the actual strength of this strategy, it relies heavily on where that shell company is legally domiciled.
Because these entities have to be registered somewhere, right? They don't just exist in the ether.
Exactly.
And the audit reveals a jaw-dropping scale here. This shadow market is highly concentrated. It's funneling a massive portion of the world's hidden real estate through just a handful of key territories.
Because geography is the absolute cornerstone of the firewall.
Right. So where are we talking about?
The audit specifically targets the British Virgin Islands, along with the Crown dependencies, so that's Jersey, Guernsey, and the Isle of Man.
Okay.
And these aren't just, random islands acting as giant filing cabinets. They act as highly specialized entry layers into major global property hubs.
But what makes those specific locations so critical? Like if I set up an LLC in Delaware or Wyoming, I get a certain level of anonymity, right? But this sounds fundamentally different.
It is fundamentally different, and it all comes down to sovereign law.
Okay, how so?
Well, Delaware and Wyoming offer privacy, sure, but they still exist within the United States federal system.
Right, so they can be subpoenaed.
Exactly.
Right.
They're subject to federal subpoenas.
Yeah.
The British Virgin Islands and the Crown dependencies, though, they operate under distinct legal frameworks that are designed by intention to refuse the collection or disclosure of true beneficial identities to outside authorities.
Okay, let me make sure I'm crystal clear on this mechanism because it's wild.
Yes.
A beneficial owner is the actual human being at the very top of the chain, right? The person who ultimately controls or benefits from the asset, even if there are like 10 shell companies in between.
Exactly. The human with the money.
So if a foreign tax authority knocks on the door of the registry in Jersey and demands to know who actually owns the shell company that just bought a $50 million penthouse in London, the registry can just say no.
In many of these specialized jurisdictions, the registry wouldn't just say no. They literally wouldn't have the information to give in the first place.
Wait, really?
Really? The local laws often only require the registry to know the name of the local law firm or the registered agent who filed the paperwork.
Oh, wow.
Yeah, the identity of the beneficial owner is kept entirely offline. It's tightly held under attorney-client privilege by those local lawyers, completely shielded by sovereign law.
So they have basically institutionalized the secrecy.
Completely. They've built an entire parallel ecosystem, and its main purpose is to blindfold the global financial system.
That's just wild. But according to the audit, the landscape of this firewall is shifting rapidly right now, like in real time.
It is. It's a very volatile period.
Right. We are moving from the historical sort of steady state mechanics of this shadow market into a highly volatile new chapter. And this is being driven by some incredibly aggressive changes in domestic tax policy.
Yes, specifically in the U.S. The most prominent catalyst currently forcing a reaction from the ultra-wealthy is the proposed California Billionaire Tax Act.
And we should clarify for the listener here, we're maintaining absolute neutrality on this.
Oh, absolutely.
Regardless of your politics or politics surrounding the initiative, we are just looking at this from a purely financial and architectural standpoint.
Right. We're just reporting on what the source says about the logistical response it's triggering.
Exactly. So let's look at the mechanics of that policy because it really explains the urgency here. The ballot initiative proposes a historic one-time 5% wealth tax. But, and this is the kicker, it is not a tax on income, which, is relatively easy to manipulate.
Right. Income is just cash flow.
Right. It is a tax on the global net worth of California residents who cross the billion-dollar threshold.
Global net worth. That's the key phrase.
Yeah. If you live in the state, California is essentially declaring that they intend to tax every single asset you hold globally, whether it's stock, art, or a hidden penthouse in London.
And taxing global net worth requires an unprecedented level of financial surveillance, which directly threatens the very purpose of that billionaire firewall we just talked about.
Exactly. But the true accelerant here, the thing causing the panic, is the timeline.
Right, the retroactive clause.
Yes. The proposed eligibility cutoff is retroactively targeted to January 1st, 2026, meaning you can't just wait around to see if the legislation passes.
Because by then it's too late.
Right. If you are a resident on that date, your global assets are captured in the net.
Which is why the audit describes the current landscape as a, quote, quiet but frantic billionaire exodus.
An exodus.
Yeah. Elite tech titans, movie moguls, ultra-high net worth individuals, they are aggressively migrating their legal residencies out of California entirely.
Trying to break the nexus.
Exactly. They are severing their legal ties to avoid falling into that tax nexus before the retroactive deadline hits.
So they're literally racing the clock to legally exist somewhere else.
Pretty much.
But the geography of this exodus is deeply ironic to me. Like, they aren't flying across the world to live full-time in the British Virgin Islands.
Oh, not at all.
Many of them are just moving right across the border to the Nevada side of Lake Tahoe.
It's very convenient.
Right. It is the exact same alpine haven, the exact same pristine lake. But crossing that invisible state line means stepping into a jurisdiction with zero state income or wealth taxes.
And that physical move across the border has triggered an absolutely unprecedented luxury real estate boom in Nevada.
I bet.
But here's the thing. The move itself isn't enough.
What do you mean?
Well, simply changing your mailing address to a Nevada compound doesn't necessarily protect your broader assets. Not if California decides to challenge your residency or tries to pull you back into their tax nexus.
No, because California is notorious for going after people who claim they've left.
Exactly. So to build a true defensive posture, these individuals are rushing to restructure their balance sheets completely.
Okay, so what does that actually mean for the real estate assets during this restructuring? Are they just changing the name on the LLC?
It's way more extreme than that.
Yeah.
Previously, an ultra-high net worth individual might have just held their luxury properties in standard corporate LLCs.
Right, just a basic holding company.
But an LLC might not offer enough legal distance to definitively break a tax nexus, especially against a sweeping global wealth tax like the one proposed.
Okay.
So what they're doing is pulling their physical real estate assets out of those LLCs entirely and burying them deep within irrevocable blind trusts.
Okay, I need to push back on the practical reality of this for a second. Because the term irrevocable blind trust sounds incredibly restrictive. Like, if I put my $50 million Tahoe mansion into an irrevocable blind trust, the irrevocable part means I can't change my mind, right? I can't just take the house back.
That is correct. You are legally relinquishing ownership.
Right. And the blind part means I have absolutely no control over how the independent trustee manages the assets.
Correct. Again.
So, how does this actually work in the real world?
Yeah.
Like, if I don't own the house anymore and I don't control the trust that does own it, how do I actually get the keys to go sleep in the primary bedroom?
You're going to love this.
Do I have to, like, rent my own house from my ghost company?
That is precisely what you do.
Wait, seriously?
Seriously. I know it sounds absurd to the average person, but paying rent to use an asset you formerly owned is a core mechanism of this strategy.
That is wild.
The independent trustee manages the property, right? And if the billionaire wants to use the Lake Tahoe compound for the weekend, they sign a lease agreement and pay fair market rent into the trust.
They are writing rent checks for a house they effectively bought.
Yep, all to maintain the legal fiction that they have no direct connection to the property.
To prove they don't own it.
And by doing so, they are legally arguing to the state, look, I don't own this and I don't control this. I am merely a tenant. Therefore, you cannot calculate the value of this massive physical asset into my personal global net worth.
Wow. It is a highly aggressive defensive posture.
Using the absolute most rigid legal structures available.
Okay, but this brings us to the biggest, just most glaring question in all of this.
Wait on me.
We've mapped out the how, we talked about corporate wrapping, the sovereign firewalls and the crown dependencies, the irrevocable blind trust where you rent your own bedroom.
Right.
But I am struggling with the core logic of the what.
What's the disconnect?
Well, if the ultimate goal of the 0.1% is absolute financial invisibility, especially when you're fleeing aggressive wealth taxes, wouldn't it be immensely easier to just hide digital cash or stock portfolios?
You would think so.
Right. Like, a string of digital numbers on a server in Switzerland seems infinitely easier to conceal than a 50,000 square foot compound on the edge of a lake.
Yeah, that makes logical sense.
Why go to these extreme, highly expensive lengths to wrap heavy, unmovable, highly visible brick-and-mortar real estate? You can literally see these compounds from space.
It is the perfect question. And the answer is really the major revelation of the entire audit.
Okay.
Tangible brick-and-mortar real estate has actually become the ultimate loophole in global financial transparency.
A loophole? How?
Yes, you can see the house with your own eyes, but the global financial system cannot trace the money tied up inside it.
How is that even possible today? I would assume moving $50 million in cash to buy a house sets off, like, every alarm bell in the international banking system.
It does set off alarms initially, but you have to look at how international treaties currently police wealth. Over the last decade or so, global frameworks have clamped down aggressively on digital assets. The source highlights a very specific framework. It's called the Automatic Multilateral Exchange of Information, or AEOI for short.
AEOI, right. So under this automatic multilateral exchange, if I'm trying to hide, say, $1 billion in liquid cash in Zurich, those Swiss banking servers are effectively forced by international treaty to talk to the tax servers back in my home country, right?
Exactly.
So the digital borders are basically gone.
They are. The AEOI is a global standard requiring participating countries to automatically exchange financial account information. The days of quietly wiring cash to a secret offshore bank account, just assuming it will stay hidden.
Those days are over.
Largely over, yes.
Yeah.
The digital trail is tightly monitored across borders now. But, and here's the critical distinction.
Yeah.
These historic transparency frameworks strictly target liquid financial accounts. They do not cover physical real estate.
Wait, seriously?
Seriously.
The international treaties that were specifically designed to track hidden global wealth, they just skipped over houses entirely.
They did. They focused on the liquid capital that moves instantly. Because physical property registries are notoriously localized, they're highly fragmented, and as we discussed with the secrecy jurisdictions, they're often completely opaque.
Right.
So the treaties govern bank accounts and stock portfolios, not county property deeds, and definitely not the shares of the offshore shells holding those deeds.
Okay, let me walk through a scenario just to make sure I grasp the magnitude of this loophole, because it's massive.
Go for it.
If I have $1 billion in a digital bank account, the global banking system is watching me like a hawk.
Yes, they know exactly where it is.
And I am going to get taxed on it. But if I take that $1 billion, route it through a shell company in the British Virgin Islands, and use it to buy a massive physical estate in Nevada, the second that liquid cash converts into brick and mortar, the reporting trail just goes dark.
It goes completely dark.
Yeah.
The money essentially vanishes from the global transparency radar.
That is unbelievable.
You have perfectly described the mechanism. Converting liquid capital into high-end real estate through offshore shells allows them to dodge the digital tracking grid entirely.
Wow.
But, preserving anonymity is really only one layer of the benefit here. Tangible assets wrapped in corporate shells accomplish several other financial goals simultaneously.
Such as? What else does it do?
Well, first, it allows them to dodge compounding property appreciation taxes.
How does that work?
When the time comes to, quote-unquote, sell the property, they often don't sell the house itself. They simply sell the shares of the offshore shell company that owns the house.
Oh, so the physical deed never actually changes hands at the county office.
Exactly. So no local transfer taxes are ever triggered.
That is so smart. And legally avoiding taxes is one thing, but what was the second benefit you mentioned?
Second, it allows them to legally bypass international sanctions.
Ah, because freezing a bank account takes one keystroke, but seizing a house is a logistical nightmare.
You hit the nail on the head. If a government wants to freeze an oligarch's assets, a digital bank account can be locked instantly. Just a push of a button.
Right.
But it is vastly more difficult to seize a physical property that is wrapped in layers of anonymous trusts spanning 3 different sovereign legal systems. I mean, even figuring out who to sue becomes an international jurisdictional crisis.
It is a brilliantly engineered void. Like, they aren't buying real estate because they need a place to sleep.
No, they already have plenty of those.
Right. They are buying it because it is literally the only asset class massive enough to absorb billions of dollars of wealth while simultaneously being entirely blind to the international banking treaties.
That is the synthesis of the entire audit right there. For the ultra-wealthy, a house is not a home.
No.
It is a highly sophisticated, anonymized financial instrument engineered from the ground up to stay invisible to the rest of the world.
Wow. It really brings us full circle, doesn't it?
It does.
We started this deep dive thinking about that clear, visible line of a standard property deed. The way the rest of the world views ownership.
Just walking into a county clerk's office.
Right. And what we found is that at the highest levels of global wealth, that line has been intentionally erased.
Completely scrubbed.
It has been replaced by this massive firewall of shell companies, crown dependencies, and irrevocable blind trusts, where you literally pay rent to a ghost just to sleep in your own bed.
It's wild. The standard operating procedure we all take for granted simply does not apply to them. The rules of ownership are entirely rewritten through geography and corporate abstraction.
Yeah. But as we wrap up our look into these sources, there is a fascinating angle to all of this that I really think you, the listener, should ponder long after this deep dive ends.
Absolutely.
We've established that physical, unmovable brick-and-mortar real estate is the ultimate loophole for hiding immense wealth. They are deliberately turning liquid cash into heavy, physical compounds to escape the digital tracking grid, which means they are essentially tying their net worth to the physical earth.
A physical earth that is, frankly, becoming increasingly volatile.
Exactly. What happens when the physical earth itself becomes unstable?
It's a huge blind spot.
If the ultimate tax haven is a sprawling $50 million estate in a dense mountain forest or a coastal penthouse right on the shoreline, what happens when global events like rising sea levels or extreme, unprecedented weather threaten those exact physical locations?
It introduces an entirely new definition of risk to the equation. because the legal firewall engineered by the best lawyers in the world might be completely impenetrable to a tax investigator.
But it cannot stop a wildfire.
No,
A blind trust cannot negotiate with a flood.
it sure can.
If you bury your wealth in physical locations to escape the digital tax grid, can that perfectly structured offshore financial instrument simply wash away or burn down?
It's a very real possibility.
In their rush to exploit the ultimate loophole, the 0.1% might be backing themselves into the ultimate trap. It is a very, very different kind of vulnerability.
And it's one that wealth managers cannot simply draft a new contract to avoid. When you trade liquid digital assets for physical isolation, you are suddenly at the mercy of the elements.
The legal paperwork might be bulletproof, but nature always has a way of cutting right through the corporate wrapping.
That's a great point.
Definitely something to keep in mind the next time you see headlines about extreme weather hitting luxury enclaves. Thank you so much for joining us on today's deep dive into the architecture of global real estate secrecy.
Thanks for having me.
Keep questioning the structures of the world around you, and we will catch you on the next one.